Global stock market traded with a mixed tone on the Wednesday as the investors weighed interest rate expectations, upcoming economic data, and the corporate earnings. The United States equities slipped across the major benchmark, while the Canada posted modest losses, and the Latin America markets diverged, with the Brazil showing the resilience even as the Mexico and the Chile retreated. On the Wall Street front, the downturn was broad based but relatively mild. Also, the Dow Jones Industrial Average fell 171.50 points or 0.37% to close at 46,121. Also, the S&P 500, widely also regarded as the best barometer of the United States market, lost 185 points, also, or that is the 0.28%, finishing at 6,000. The tech-heavy names also saw selling pressures as the Nasdaq, the composite, declined 75.62 points or the 0.33% to the 22,497.86. Small cap stocks were hit harder, with the Russell 2000 sliding 0.92% to 2,400. Interestingly, despite the declines, the investor nerves appeared steady on the CBOE Volatility Index, or the VIX, that slipped 2.76% to 16, suggesting that the traders view the pullback as the profit-taking rather than a deeper sell-off. In Canada, the equities mirrored the US trends, but with the softer losses, the TSP and the S&P TSX Composite Index also dropped 58.68 points or 0.20% to settle at 29,756, while the S&P 60 edged down 0.12 to 1,700. Energy and the financial stocks dragged on the performance as the investor tracked the oil price movement and the global demand outlooks. Elsewhere in the Americas, the markets presented a mixed picture. The Brazil's Bovespa index managed to buck the trend, inching the higher of the 66.81 points or 0.05% to 1,46,000. Also, the gains in the commodity-linked sectors helped offset the global risk-off sentiment. In contrast, Chile's S&P IPSA fell 32.01 points or 0.35% to 9,114, while the Mexico's S&P BMV IPC suffered one of the sharper decline in the region, sinking 462.24 points or 0.74% to reach 61,900. The divergence underscored how the country's specific factors, from the industrial performance to consumer demand, continue to shape the market direction. Overall, the trading across the region was marked by caution. The investors are awaiting the key United States economic reports on the inflation and the jobs, which also could heavily influence the federal funding, also the Federal Reserve's monetary policy path. With the indices still near the record highs, even the slight surprises in the economic data could swing market sentiment quickly. Analysts noted that recent pullbacks are likely part of a natural pause following a strong gain in the recent weeks rather than a shift towards the prolonged weaknesses. Looking ahead, the global markets will continue to react to the central bank signal, the corporate earnings, and the macroeconomic data. For now, the volatility remains muted, suggesting that the investors are not also rushing to unwind the positions but are also instead adjusting the portfolios carefully in the anticipation of the next market moving catalyst. Commodity markets traded mixed on the Wednesday, with the energy prices mostly lower, the metals also showing slight weakness, and also the agricultural products edging higher. Traders balance shifting supply-demand dynamic. The geopolitical considerations have also been very heavy, and the currency movements keeping it low, while also keeping an eye on the broader economic outlook that continues to the influencing of the raw material demand. A lot of this is happening because of the Donald Trump taxes. In energy markets, crude oil prices slipped as the investors reassessed the global demand prospect. The WTI crude oil futures fell $0.29 or 0.45% to settle at $64 per barrel, trading within its 52-week range of the $55 to $79. The Brent crude oil, the international benchmark, also eased, declining 0.24% or 0.35% to reach $68 per barrel compared to its yearly range of the $58 to $82. Analysts attributed the mild pullback to concerns about slowing demand growth, particularly in the major consuming economies, although the supply discipline from the OPEC Plus members provided some support. The natural gas also bucked the trend, rising 0.02% or 0.57% to reach $3.15 per million BTU, with the prices moving between $2.21 and $4 over the past year. Stronger seasonal demand and tightening inventories also gave the contract a modest boost. The precious metals traded with little conviction as investors awaited further signals from the central bank. The gold futures were virtually flat, dipping to just 0.20% to $3,700 an ounce, holding near the upper end of their 52-week range between the $2,000 and $3,000. Silver also slipped, the $44 per ounce after the recently testing higher needs, that is $44. The market participants said that the metal complex is consolidating after the sharp gains, with the safe haven demand steady but tempered by the strength in the United States dollar. Agricultural commodities were mixed but also generally firmer. The soya beans rose by 0.02% or 0.15% to reach $10 per bushel, supported by the steady export demand and concerns that about of the weather pattern affecting crop yields. Prices remain within relatively tight, and this range is going to continue. The soya beans also is the sensitive to the developments in the global trade flows and climate forecast.